Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to talk about Module B Risk Management, Chapter 8 Risk and Basic Management Framework. In this chapter, you will understand the concept of risk, conceptual understanding of the linkage among risk, capital, and return, and why risk needs to be managed. So, if you have clicked to watch this video, be rest assured you have reached a channel that will give you a treasure of knowledge. That is our promise. So please subscribe and become a lifetime learner. So if we talk about risk, we may define risk as any uncertainty resulting in adverse outcome, adverse in relation to planned objective or expectations. Financial risk are uncertainties resulting in adverse variation of profitability or outright losses. So anything which is uncertain and leads to loss is a risk. Simple. The possible unfavorable impact is the risk of the business. Now, lower risk implies lower variability in the net cash flow. With lower upside and downside potential, higher risk would imply higher upside and downside potential. So, this is another way of understanding the implication of risk. So, if we define uncertainties associated with risk elements, it impacts the net cash flow of any business or investment. So, this is also a very important factor. Uh, Zero risk will imply no variation in the cash flow. Capital requirement of business or revenue model would depend upon the risk associated with the business. Now, more the risk, the more profit normally the organization makes. But controlling the level of risk in an organization uh, is the essence of risk management. So, we all know that no matter what business you do, there will always be risk. But how efficiently you manage that risk to get the maximum profit is called risk management. Now, let me ask you a few questions, and I hope you will be able to answer these questions. Investment in post office time deposit is, please answer. Question number two, zero risk investment implies. Okay. Question number three, which of the following statement is correct? Let me make these statements. Higher the risk, higher would be the risk premium. Higher the risk, lower would be the risk premium. And lower the risk, higher would be the risk premium, which is the correct statement. Now, what is the most critical function of risk management? You can answer these questions in the description box below. Now, let's talk about basic risk management framework. Now, management of risk is a major concern for the top management. Management of risk begins with the identification and quantification of risk. Now, responses to these consideration calls for risk management framework in an organization. Now, it has a process covering the following areas. First is the organization of risk management, risk identification, risk measurement, risk pricing, risk monitoring and control, risk mitigation. So, if we talk about organization of risk management, normally the risk management organization consists of board of directors, the risk management committee of the board, the committee of senior level executives, the risk management support group. Now, the board articulates the risk management policies, procedures, aggregate risk limits, review mechanism, and report and audit the system. Now, the board should also decide the risk management policy of the bank and set limits for various risks. Risk management committee of a board is a sub-level committee. The responsibility of risk management committee with regard to risk management aspect includes the following. It sets up the guideline for risk management and reporting. It ensures that the risk management process conform to the policy And setting up prudential limits and their periodical reviews is also an important factor. So these are the things which needs to be taken care. Now the committee of senior level executive is responsible for implementation of risk and business policy simultaneously. Now risk management support group analyzes, monitors and reports the risk profile to the committee of the senior level executive. It also examines the effect of various possible changes in market variables and recommends the action needed. Now, what is risk identification? Now, certain risks such as liquidity risk, interest rate risk are managed at the aggregate or portfolio level. Now, risk identification consists of identifying various risks associated with the risk taking at transaction level and examining their impact on the portfolio and capital requirement. Now, what is risk measurement? Now, risk management relies on the quantitative measure of risk. The risk measures seek to capture variations in earning market value, losses due to default arising out of uncertainties associated with various risk elements. Now, quantitative measure of risk can be classified into three categories. It is based on sensitivity, volatility, and based on downside potential. So, if we talk about sensitivity, now sensitivity captures the deviation of a target variable due to unit movement of a single market parameter. Volatility, uh, it characterizes the stability or instability of any random variable. It is common statistical measure of dispersion around the average of any random variable such as earning, mark to market value loss due to default, etc. Volatility is the standard deviation of values of these variables. Standard deviation is the square root of the variance of the random variables. So this is an important thing which we need to remember. Volatility over a time horizon. If you have to calculate this, it is daily volatility into square root of t. Now, for example, the daily volatility of a stock is 1.5%. The monthly volatility would be 1.5 into square root of t. Now, square root of 30, because it is we are calculating it for monthly basis for 30 days. So this will come to around 8.22. Now, downside potential has two components: potential losses and probability of occurrence. Now, downside potential is most comprehensive measure of risk as it integrates sensitivity and volatility with the adverse effect of uncertainty. This is the measure that is most relied upon by banking and financial services industry as also the regulators. The value at risk is a downside risk measure. Now let's talk about risk pricing. Now banks have to maintain necessary capital at least as per the regulatory requirements. The capital required is not without cost. The cost of the capital arises from the need to pay investors in banks' equity in the form of dividends and for internal generations of capital necessary for the business growth. Now, risk pricing implies factoring risk into pricing through capital charge and loss probabilities. This would be in addition to the actual cost incurred in the transaction. Now, pricing therefore should take into account the following: cost of deployment of funds, operating expenses, loss probabilities, capital charge, profit margin, or return on net worth. Now, what is risk monitoring and control? Now, the key driver in managing a business is seeking enhancement in risk adjusted capital or return on capital, which is also called RAROC. Now, setting risk limits based on economic measures of risk while ensuring the best risk adjusted return, keeping in view the capital that has been invested in the business. In order to achieve the above objective, banks put in place the following: an organization structure comprehensive risk measurement approach, risk management policies adopted at the corporate level which are consistent with the broader business strategies, guidelines, and the other parameters used to govern risk taking, including detailed structure of prudential limits. Now, strong management information system for reporting, monitoring, and controlling risk, well laid out procedures, effective control, and comprehensive risk reporting framework, separate risk management framework independent of operational department with clear separation of responsibilities for management of risk, periodical review and evaluation are some of the ways through which risk can be monitored and controlled. Also, the involvement of internal or external audits, the bank's board of directors has a responsibility to ensure that the management establishes a system for assessing various risks, develop a system to relate risk to the bank's capital level, and establish a method for monitoring compliance with the internal policies. Now, let's also talk about risk mitigation. Now, the techniques to mitigate means to prevent. The techniques to mitigate different types of risk are different. For mitigating credit risk, banks have been using traditional techniques such as collateralization by first priority claim with cash or securities or landed properties, third party guarantees, etc. Now, risk mitigation measures aim to reduce downside variability in net cash flow, but the measures also reduce the upside potential simultaneously. In fact, risk mitigation measures reduces the variability in net cash flow. Now, what is risk mitigation through diversification and portfolio risk? Risk can be mitigated through diversification. The ratio of standard deviation to the mean is measuring of comparing risk associated with similar cash flows. So let me ask you certain questions. I hope you'll be able to answer these questions. Capital charge component of pricing accounts for. Okay. Question number 2. Daily volatility of a stock is zero point 0.5. What is its 10-day volatility? I hope you can easily calculate it. Risk mitigation results in. So I'm sure you'll be able to answer all these questions. And if you have reached at the end of this video, be rest assured you have reached a channel that will give you a similar treasure of knowledge. And that's a promise. So please subscribe and become a lifetime learner. Thanks for subscribing our channel. Have a great day.